Welcome, this is Professor Lazarus again, and in today's segment we will be talking about dividends, specifically the allocation of dividends between preferred shareholders and common shareholders. So before I get into the example, I'm going to step aside for a minute and give you a chance to write down the question and the example on the whiteboard behind me, and then the accompanying solution on the side here. So please go ahead and get your pen and pad ready and write down this information. Okay, now that you have that information down, let's refresh our memory with the term dividends. What do we mean by dividends? Dividends pretty much is a distribution of the company's profits to its shareholders. Now, in some cases, dividends will also represent a return of the original investor's capital, but by and large, in most cases, dividends would be the distribution of the company's profits. So with that as a backdrop, let's look at the example that I have on the whiteboard behind me. Morgana Engineering Corporation has 2,000 shares of 4% $100 par cumulative stock outstanding and 30,000 shares of $1 par common stock outstanding. Here's a question. If the board of directors declares $50,000 of total dividends in 2011 and did not pay any dividends last year, this is what we call dividends in arrears, how much will the preferred and common shareholders receive in totality this year in 2011 as well as on a per share basis? That's the question. So let's see how we can work this out. Before we get into the solutions, a couple of guidelines to keep in mind. First of all, the company has no legal obligation to pay dividends at all. So a company can have 25 years of profits and never pay a single dollar in dividends. The obligation to pay dividends only comes when the board of directors formally declares a dividend distribution. That's the date of declaration. It is at that time, on the date of declaration, that the company would normally record a liability. But if there's no formal declaration, then there's no legal obligation, no liability is recorded. That's one point you want to keep in mind. The second point is that, as in this example, a company has both preferred and common shareholders. So in that case, the preferred shareholders will get the dividends first and have to be satisfied fully before the common shareholders will receive any dividends. The next point you want to keep in mind is if the preferred stock, is it cumulative or non-cumulative? Let's look at the data here, and it says here in this case that your preferred stock is cumulative. So what does that mean? If the preferred stock is cumulative, that means that if the company goes past a year without paying any dividends, then the next year when the company declares dividends, if they declare dividends next year, the company would have to satisfy the preferred shareholders fully for the year that they did not pay the preferred shareholders the dividends. Then they have to next satisfy the preferred shareholders fully for the current year, and then if there's money remaining, the common shareholders will get the dividends. That's if the preferred shares are cumulative. If the preferred shares are non-cumulative, then under the same scenario, if the company goes for a year and does not pay the preferred shareholders any dividends, the next year, if the company declares dividends the next year, then under this non-cumulative preferred share scenario, the company does not have to go back and make good the dividends for the preferred shareholders for the year that was lost. In other words, the company only has to make good the preferred shareholders' dividends for this current year, and then any leftover money goes to the common shareholders. But again, in this example, the preferred shareholders are cumulative. The next thing is, after we've read the data, is to ask ourselves, can we look at the data to determine how much money, how many dollars does it take to satisfy one preferred share fully? That data can be given to you either in terms of a dollar figure or in some other fashion that may require to do some additional calculation. In this case, this 4% here, this 4% tells us how much of dividends it takes to satisfy each preferred share fully in a given year. 4% of what? 4% of the par value of the preferred share. The preferred share par value is $100. So 4% of $100 is $4. So that means each preferred share to be satisfied fully in a given year would require $4 to be received by the preferred shareholder for each share that he or she holds. So let's get right into the solutions and continue on that discussion. And I have that listed here on the very first line. It said here, dividend paid per preferred share. Now, again, I'll put the word paid in quotations because the company may or may not pay the preferred dividends in a given year, but the $4 in this case is what it takes to satisfy the preferred shareholders fully. That's $4. So the next line here says total dividends needed per year to satisfy the preferred shareholders fully. That would be $4 for each preferred share multiplied by the number of preferred shares outstanding, which in this example is 2,000 shares. So it would require $8,000 each year for the company to give its preferred shareholders to satisfy them fully. But if you recall, in this example, the company did not pay out any dividends in 2010. So now in 2011, our job is to do what? Is to take the $50,000 that the company has set aside and figure out how much of the $50,000 goes towards the preferred shareholders and how much, if any, goes to the common shareholders. So the first part of the allocation is, it says your dividends in arrears 2010, $8,000 goes to preferred shareholders. What does that mean again? If you recall, it takes $8,000 to satisfy preferred shareholders fully. So from the $50,000, we first take a chunk of $8,000 and give it to the preferred shareholders and tell them, Mr. and Ms. Preferred Shareholders, you are getting $8,000 now to satisfy you for the 2010 dividends that we, the company, did not pay you. Next, the company takes another chunk of $8,000 and gives it again to the same group of preferred shareholders. Again, remember, both of these are taking place right now in 2011. But this second amount of $8,000 represents the amount of money that the company is paying its preferred shareholders to satisfy them fully for this current year, 2011. So at this point, how much money has the company paid its preferred shareholders of that $50,000 set aside? 8 plus 8, $16,000. So again, of the $50,000, the company has given its preferred shareholders $16,000. $8,000 to satisfy them for the 2010 dividends that was not paid, and $8,000 to satisfy them for the current year 2011 dividends. So then what's remaining for the common shareholders? What's remaining for the common shareholders is $50,000 minus the $16,000 that we paid the preferred shareholders. So the common shareholders gets the remaining $34,000. And that's how we break out the $50,000 between the preferred shareholders who got $16,000 and the common shareholders that got $34,000. So these amounts represent the first part of our question, because the first part of our question was how much do each of these shareholder groups get in totality. So one more time, in totality, the preferred shareholders in 2011 got $16,000. The common shareholders in totality got $34,000. In 2010, nobody got anything because the company did not pay any dividends. Okay? Now, the next part of the question is how much did each group get on a per share basis? Well, the preferred shareholders on a per share basis, in totality they got $16,000. On a per share basis they got $8. The common shareholders, how much did they get on a per share basis? In totality they got $34,000, right? But how many shares of common stock outstanding were there? There were, tell me again, 30,000 shares. There were 30,000 shares of common stock. So on a per share basis, you took the $34,000 that the common shareholders got, divided that by the total number of common shares outstanding. So on a per share basis, each common stock share received $1.13. So this is how we do the allocation between the preferred stock as well as the common stock. Now recall, if this example had preferred shares that was non-cumulative, how would this example change? Think about that for a moment. The way the example would have changed was that you would not have had to give preferred this $8,000. So the preferred would have only gotten this $8,000, and then the remaining $42,000 would have gone to the common shareholders. That's how the allocations would have differed slightly if the preferred stock was non-cumulative and everything else was the same. So I hope you found this discussion useful, and this pretty much wraps up this segment. And as I always like to say, this is Professor Lazarus signing off, and we accountants always work our assets off.